You know why casinos don't have clocks on the walls? And why they pump extra oxygen into the room and give you free drinks? It's because the longer you stay and the fuzzier your thinking gets, the more money the house makes. Well, the banking industry looked at Vegas and said, "Hold my beer." We're taught that credit cards are tools, convenient, safe, responsible even. They tell us it's the key to building a credit score, to unlocking adulthood. And those airline points? Chef's kiss. But here's the brutal truth nobody puts in the brochure. The entire credit card system is engineered with military precision to make sure you never actually leave. Welcome to Chapter 1 of the credit game. I'm about to show you exactly how the machine works. And no, we're not talking about just spend less today. We're talking about the invisible tripwires buried in the fine print, the minimum payment myth, the interest rate landmines, and the cash advance black hole. If you've ever stared at your credit card bill, confused why the balance never seems to go down, even though you're paying every month, this video is your answer. By the end of this, you're going to look at your wallet differently. You're going to see the game for what it is. And once you see the strings, they can't pull them anymore. Let's get into it.
Okay, let's start with the most dangerous number on your entire bill. It's not the total balance. It's that tiny, friendly-looking number at the bottom, the minimum payment. You owe $5,000, but the bank whispers, "Hey, relax, just send us $125 and we're cool." It feels like a lifeline, like they're being understanding. But this is a mathematical trap designed to turn you into a permanent ATM for the bank. Here's how the scam works, and I'll keep it painfully simple. Every time you make a payment, the bank takes that money and splits it into two buckets. Bucket 1, interest. Bucket 2, principal, the actual money you borrowed. Here's the con. The minimum payment is perfectly calculated to cover all of the interest, but almost none of the principal. You're running on a treadmill, sweating, exhausted, legs moving, but you haven't gone anywhere. Let me give you a real example. Let's say you buy a nice couch for $2,000 on a credit card with an 18% APR. Pretty standard, right? You decide to just pay the minimums because money's tight, and $40 a month, that's doable. Take a guess how long it takes to pay off that couch. 2 years? 5 years? Try 14 years. You will be making payments on that couch until your toddler is applying to colleges. And here's the real kicker. By the time you're done, you'll have paid nearly $4,000 for a $2,000 couch. You bought one for yourself, and you bought one for the bank. According to a 2023 study by creditcards.com, the average American credit card balance is around $6,500. If you only pay minimums on that at 20% APR, you're looking at over 30 years to pay it off and more than $16,000 in interest alone. This is what the banks call revolving credit. I call it the retention trap. They don't want you to pay it off. They want you to stay current, just barely, so the interest keeps flowing. It's not a payment plan, it's a subscription fee to your own poverty. Rule number 1, the minimum payment is designed to keep you broke.
Now, maybe you're thinking, okay, but I'm smarter than that. I'll just transfer my balance to one of those 0% APR cards. Problem solved. Oh, sweet summer child. Let me introduce you to trap number 2, the interest rate sleight of hand. You see these offers everywhere. No interest if paid in full by December. 0% financing for 12 months. It sounds like free money. It gives you breathing room. But notice that very specific wording, if paid in full. Here's how they get you. Let's say you buy a $1,000 laptop on a 12-month promo. You hustle. You pay off $950. You're this close. But life happens. Car breaks down, emergency vet bill, and you miss the deadline by 1 day, leaving just $50 on the balance. Common sense says you pay interest on that $50, right? Wrong. Because you didn't hit 0, the bank triggers something called retroactive interest. They go back in time, all the way to day 1, and charge you 12 months of back interest on the entire $1,000, even the part you already paid off. According to Consumer Financial Protection Bureau data, Over 14% of consumers using deferred interest promotions get hit with this trap. The average retroactive charge? Around $750. It's not a grace period, it's a trapdoor. Miss the landing by 1 inch, you fall all the way to the bottom. And while we're here, let's talk about the penalty APR, aka the kick 'em while they're down clause. If you're 60 days late on any payment, the bank can strip away your normal interest rate and slap you with the penalty rate. We're talking 29.99% APR, sometimes higher. At 30% interest, your debt grows faster than you can possibly pay it off. It becomes a mathematical death spiral. One mistake, one forgotten autopay, and the difficulty setting on your life goes from hard to impossible. The Federal Reserve reports that as of 2024, the average credit card interest rate in the U.S. is sitting at 21.47%, the highest it's been in decades. And penalty rates? They can legally hit 29.99% or more. You're not fighting a fair fight.
All right, there's one button on the ATM I need you to mentally superglue shut. Trap number 3, the cash advance. We've all been there. You're at a bar that's cash only, or you're short on rent, and you think, I've got $5,000 of available credit. I'll just pull out $200 real quick. Do not do it. Here's why. When you swipe your card for groceries or gas, you typically get a grace period, usually 21 to 25 days where no interest is charged. Pay it off within that window, the loan is basically free. But a cash advance, that's radioactive. First, 0 grace period. Interest starts tipping the second the cash hits your hand. Second, the interest rate on cash advances is often higher than your regular purchase rate, sometimes 25% or more. Third, they charge you a fee up front, usually 3% to 5%, just to hand you your own money. So if you pull out $100, you immediately owe $105 plus interest starting today at a jacked up rate. According to Bankrate, the average cash advance fee is 5%, and the average APR is around 25.24%. On a $500 cash advance, you'd pay $25 up front, then rack up about $10 in interest in just the first month if you don't pay it back immediately. You're lighting money on fire. If you're using your credit card like an ATM, it's a red flag, not just to the bank, but to your future self. It's a sign of desperation, and unfortunately, banks charge a premium for desperation.
Here's the thing. If you're sitting here right now feeling overwhelmed by your credit card debt, if you feel stupid or guilty or ashamed, stop. You're not losing because you're bad at math. You're losing because you're playing against a supercomputer designed to keep you in the red. The minimum payments, the retroactive interest, the cash advance fees, these aren't accidents. They aren't bugs. They're features. But now, you know the mechanics. You know the minimum payment is a treadmill. You know the 0% offer is a ticking time bomb. And you know the cash advance is financial poison. Knowing the traps is step 1. But here's the question that keeps me up at night. Even if we know the math, why do we still swipe? Why do we buy things we don't need with money we don't have? That's where it gets really interesting. In Chapter 2, we're diving deep into the psychology of debt. We're gonna expose the brain hacks, the rewards programs, the points, the gamification that banks use to bypass your logic and target your dopamine directly. They're not just tricking your wallet, they're hacking your brain.